Phil, thank you very much for being here.
Thank you for having me.
It's a pleasure listening from you, learning a little bit about your perspective about the region. And when you talk about Latin America, you are a big expert. But tell us why. Tell us more about Seven Bridges and your experience in the region.
So Seven Bridges, we started in 2015. We're currently active in Brazil and Mexico. We have assets in both countries. We haven't done anything in the Andean region, although we do have an office in Bogota. In my career, I've invested in 7 different countries in Latin America and have invested in the development of roughly 120,000 for-sale housing units, office buildings, industrial buildings, resorts and hotels. So we've done a little bit of everything. We have local teams in each market, and we're really we're kind of global perspective, but locally focused on what executing and managing the opportunities.
And how do you see Latin America now, considering the global context? Are you positive about Latin America? Are you worried about it?
I'm always worried about everything, right? I mean, we're stewards of capital, and it's other people's money. So I'm always worried about it because we want to make sure that we take good care of their investments and deliver to them, to solid returns. The things that, we tend to avoid. I mean, we don't tend to. We avoid the markets where you really have to, stay up at night worrying about things. So there's no Argentinas and there's no volatile markets in our portfolio. I'm also stay away from small markets that have what I would call event risk. If you're in a small town that's got maybe 1 or 2 industries and that industry has some sort of disruption, you can lose your business pretty quickly. So we want to be in larger diversified markets. I mean, while we're obviously a country investor, we're really a city investor. And so what cities do we like? We like Sao Paulo. We like the big industrial markets in Mexico. So we try to stay away from these places where we have to worry about disruptions.
Interesting. Talking about Mexico industrial real estate, there's a lot of things going on now with nearshoring. Could you open some numbers for us? Anything that would feel comfortable sharing with us in terms of performance in the region? Are you happy with the way businesses are going there? Do you feel comfortable sharing anything with us?
Sure, of course. We have a large portfolio. We've got 4.5 million square feet of industrial space in 4 markets in Mexico. We're in Juarez, Reynosa, Monterrey, and Guanajuato. Well, in the San Miguel area of Guanajuato, the state of Guanajuato. Right now the markets are performing better than we ever underwrote. The nearshoring effect has really accelerated. We made a bet and entered the market 2 years ago for industrial.
Timing.
It was good timing. I actually wanted to enter sooner, and maybe we could have done a little bit better than we did, but we have a very attractive basis. The interesting thing about the nearshoring and where, I was sort of overly optimistic about how quickly this would happen was in 2016, we could see just by data and by the rhetoric and the political rhetoric and trade wars with China that companies were going to nearshore. I thought that would probably take 2 years to start seeing that migration. It really took 4. And the reason for that is, these companies don't just shut down a $2 billion plant in China and pick up and move overnight to Mexico. What they're doing is they have to they have to build the plant, they have to find the property, assemble the plant, then they have to go through certification processes. There's a whole process that goes into it. So from start to finish, that's probably more like a 4-year process, not a 2-year process. So we're getting the fruits of it. It's all great. It's all going really well. And to give you an example, in Juarez, Mexico, we have properties where our rents were running around $4.50 a foot per year. And now they're $8 a foot. That's just in 2 years.
Wow.
I mean, we couldn't have underwritten that growth, and I wouldn't have, even if I thought that, I probably wouldn't have put it on paper because that's not the kind of promise I want to make to anybody.
Makes sense. You're better surprised than making promise that
Absolutely. But the markets, just going back to your question, where are we right now? I mean, this is publicly available information. Vacancy rates in the major industrial markets in Mexico are at below 3%.
Wow. So
there's more demand than there is supply. Supply's not keeping up. The big challenge we have in Mexico right now is power supply. There's not an adequate, and it's not production of power, it's transmission of power to where these industrial parks are. So if you have a park, like we have a park in San Miguel with 66 gigawatts substation, megawatt substation, if you have adequate power, you're in high demand. And that's going to be the biggest challenge for the foreseeable future for industrial is where do you develop where you can get access to power? The one thing about Latin America, and one of the reasons why we're so bullish on it, is because of the demographics. Most northern and western economies actually have shrinking population bases, but for immigration. Latin America has got inherent growth. It's built into the demographics. Their birth rate is above replacement. Our birth rate is below replacement here in the United States. And so now, what's the opportunity? Housing. Everybody needs a place to live, right? That's the one piece of real estate that we all have to have. The problem is that a lot of that real estate is at a price point that's not economically viable from a foreign investor's or even a local investor's perspective. Those are the policy-driven decisions that we are not part of. But one of the things I'm very bullish on regionally right now is multifamily for-rent housing in the infill locations in these major cities. Affordability is an issue for buyers of real estate, and we can give them a high quality of life and in a good location. And it's a rental property, and it's absolutely nascent asset class in Latin America. There's a dearth of other things, but not this. So, like one data point I'll give you, in Santiago, Chile, which is a city roughly the same size as Houston, which is where I'm from, there's about 30,000 purpose-built multifamily units. In Houston, there's 600,000.
Wow.
Actually, it might be 650. I'm not sure. I lost count. But so just to give you an idea, so there might be an oversupply of some things, but there is an undersupply of multifamily. And the other part of this is we're very climate focused at Seven Bridges. We're looking at building resilience into our projects and being good stewards of the environment. So our entire multifamily strategy is built around sort of climate-first construction and operating techniques.
Great. And let's move to the office sector. We're here in New York, where we have after COVID, the working from home impacting the demand.
Mm-hmm.
But on top of that, we have high interest rates, a lot of the debt coming to refinancing time now.
Mm-hmm.
People talk about almost $1 trillion coming to be refinanced. A lot of distress coming to the market. Is it anywhere close to this in Latin America?
Not remotely, not even. And I would say that, this is one of the, I guess one of the cautions I would make. We're talking about Latin America, and really, again, every country is different and every city is different. So in Brazil, for instance, we're seeing record high rents being set at the prime locations in São Paulo. We had opportunities to buy office buildings in the last 5 years in Rio. And so where local experience really matters is we're looking at Rio and looking at the economic situation in Rio, the politics, et cetera. I didn't really see a runway where the office market in Rio is going to recover. Well, in Sao Paulo, which is the capital for the services sector, banking services, financial services, it's pretty clear to me that in the prime markets in those locations, you're going to have office demand. Culturally speaking, people are coming back to work. They're not working from home the way they are in the U.S. So culture matters in terms of determining whether or not that property is going to be used and be fully utilized. In Latin America, these offices are being fully utilized. Sure, there's work from home, but it's not the same situation there. So prime office markets in Sao Paulo, Faria Lima, Paulista, vacancies are under 10%. Utilization is high, and record high rents are being set on new leases. You're starting to see in the the secondary submarkets in Sao Paulo, you're starting to see those offices now fill up. So the trend in Sao Paulo is very, very positive. That's really not true in Rio. It's also not true in Mexico City. Mexico City has got an oversupply, and Mexico City office market has been oversupplied for as long as I can remember. That's not a post-pandemic. That's not a work-from-home thing. That's just the way it's been. Yeah. It's kind of structural at this point. I don't really I can't explain it.
Our final question here. You're probably dealing with a lot of foreign investors that analyze investors that want to deploy capital in the region. Mm-hmm. And they have some of their own concepts. They make their own mistakes sometimes when they go there by themselves. What's the most usual mistake you see, or the misconcept that they have when they look at Latin America and the opportunities that the region can offer them?
I think the biggest misconception is that it's all one, that the region is somewhat homogenous, that there's, that it's all one sort of country, if you will. the economics of each country are very different, and the economics of each city are very different. And in the end, what are we really doing? We're underwriting the corner of, it inside of a city. We're underwriting that city, and then we're underwriting the country. So that overlay. So I think this perception or misconception that Latin America is just homogenous is a big mistake. I think one of the mistakes I've seen investors make in making placing their bets in Latin America or really emerging markets in general is investing in a thing that's not replicable, where there's not a pipeline, a scale, and it's not replicable. And so they do a lot of work and they make an investment, but it's kind of one and done, and they can't do it again. And I guess probably the last thing is I would look to, just to give myself a little, advertising here, I would look to folks like us who have a regional presence and a long history in the markets. So they've seen where the mistakes have been made and what to avoid. And the other thing is if you're making a bet on one market in one sector and you don't have the resources to really underwrite that and really follow it and really analyze it, if that's the wrong bet, there's not a whole lot you can do. Whereas if you're investing sort of regionally, if you're, sort of putting your money in a regional fund or a country fund that can do, many things, the manager can pivot, right? The manager can pivot. But if you're at a life company or a pension fund here in the United States, you don't have the resources to fully understand those things and keep up with them. I think you could end up, being surprised to the downside.